Have you read the Little Book of Common Sense Investing? No? Well, not to worry, because today I'm gonna dive deep into the wisdom of yet another investing legend who transformed investing for millions of people. It's Jack Bogle, founder of the Vanguard Group and often known as the father of index funds. In this book, he shared these timeless principles on investing that I believe we all must embrace. So let's imagine a friend. Let's call him Steve, who loves picking hot stocks. So one year, his tech stocks were soaring and everyone was talking about them. Steve was also convinced that this was the future, so he poured all his savings into the hottest tech companies. He felt like a genius as his portfolio skyrocketed. But then, the inevitable happened. The tech stock, after an incredible run, started to slow down and eventually tanked. Steve was confused and panicked. What he didn't understand was the reversion to the mean. Jack Bogle mentions that the extraordinary returns, whether incredibly high or incredibly low, rarely last forever. Over time, things tend to settle back towards their historical average. So reversion to the mean basically means all extreme deviation from the mean will be short-term. So any over and underperformance, eventually they reverse to their mean. So don't chase the trend because eventually it's gonna cool down. Now let's talk about Steve's sister, Sarah. She wasn't as impulsive as Steve. When she started her job, she set up a small automatic investment every month into a broad market index fund. She didn't check it daily or even monthly. She just put everything in a system and let the automation do the rest. Now, years later, when Steve was still trying to find the next big winner, Sarah's modest, consistent contributions had compounded into a substantial amount. This is the power of time in the market and not timing the market. Jack Bogle always emphasized that the greatest asset an investor has is time. The longer your money is in the market, the more powerful compounding becomes. It's like a snowball rolling downhill. It starts small but gets massive over time. So the longer you invest, the larger the leverage of time. Now, many people scared by the market fluctuation decide to keep all their money in the savings account. Let's say Nick. Nick saw Steve's struggles and Sarah's slow and steady approach and thought, it's too risky. I'll just keep my money safe. But what Nick didn't account for was inflation, the silent thief. Over decades, the purchasing power of his cash slowly declined. Jack Bogle said that you must invest. To truly grow your wealth and outpace inflation, your money needs to work for you in productive assets like businesses. The alternative is not safe. It's a guaranteed loss of purchasing power over the long run. So not investing is the biggest risk that you can take. Now Steve, after his tech stock roller coaster, became so disappointed. He expected to get rich quickly. Sarah, on the other hand, never expected to be a millionaire overnight. She understood that investing was a marathon, not a sprint. Jack Bogle always preached the right expectation. He knew that realistic returns, averaging between 6 to 8% annually over the very long term after inflation. Anyone promising a significant return year on year is possibly a scam. Understanding the right expectation will help you stay disciplined and avoid emotional traps of fear and greed. So unrealistic expectations drive people into bad, risky investments. At 7% return, your money doubles every 10 years. Now here's this funny analogy that Jack Bogle loves. Imagine you're looking for this specific needle in a giant haystack. You could hire a team of expensive needle picker who would separate through individual strings of hay, charging you a fortune and hoping to find the sharpest, the shiniest needle from that haystack. For your reference, the haystack is basically the entire market, and the needle is that great company that you're looking for. Or you could be like Sarah. She just bought the entire haystack, a low-cost index fund that owns a tiny piece of every company in the market. She knew that the needles were in there somewhere, and by owning the whole haystack, she guaranteed she'd get them all without paying those hefty picking fees. Index funds are a great opportunity to be in the market without doing your own research. Now back to Steve. Steve was always doing research, reading every financial headline, watching market experts trying to predict the next move. This led him to constantly buying and selling, racking up trading fees and often buying high and selling low. On the other hand, Sarah's research was different. It was the initial decision to invest in a low-cost, diversified index fund. Once that decision was made, her holding tight strategy kicked in. She understood that market fluctuations are normal, and reacting to every ups and downs usually hurts return. Bogle says that true research for the average investor wasn't about predicting the next hot stock, but understanding the fundamentals of long-term investing and constructing a sensible portfolio. Once you do that right, the best action is often hold tight. This brings us to the final and possibly the most crucial point. Steve was a master of reaction-ism. A market dip, panic sell. A hot tip, buy aggressively. He was constantly in motion, whereas Sarah practiced inactivity. When the market dipped, she might felt a little bit of worry, but she remembered her plan and did nothing. In fact, if anything, she continued her automatic investments, buying more shares at a lower price. You will get bombarded by negative news all the time. The best thing that you can do for yourself is stay the course and not get affected by the noise. Jack Bogle taught millions to build wealth not with fancy tricks, but with wisdom, patience, and simple index fund investing. If you found this story helpful, give it a thumbs up, subscribe to my channel, and share with your loved ones. Thanks for watching. I'll see you in the next one.